Well, stocks jumping today on the heels of the S&P 500's worst week since early 2023. For more on the latest market moves, we want to welcome in Ahmed Riesgo. He is Insigneo Chief Investment Officer. Ahmed, thank you so much for being here. So we had this bad week last week. Now we're sort of muddling along until we get the Fed decision. I think fair to say you are not a full bull at this point in time. So do you think that once we get past the Fed, that the market will be able to more sustainably rally?
Hi. So no, unfortunately, I do not. We actually switched our stance to U.S. equities to underweight at the beginning of July. We think we've seen the highs for the market for the year. And the reason why, it's basically because we continue to see concerns in the labor market, specifically the U.S. labor market. We see the job vacancy rate is flashing warning signs. I mean, there's a slew of indicators of labor demand that are pointing in the wrong direction. With that being said, a lot of the emphasis has been on the Fed and when and where they're going to cut rates. We think ultimately that only matters if the U.S. can avoid a recession. If it does not, we see a tough slog for stocks into the second half of the year.
So is that your forecast, though, Ahmed? I mean, do you see an economy beyond just cooling and moderating? Do you expect it to tip into contraction?
We do. I also want to emphasize, I don't think it's going to be a severe recession, unlike the two previous recessions, both COVID and the global financial crisis, which were severe exogenous shocks. We think this is going to be a much more run-of-the-mill type of recession where the Fed raises rates and tips us over into contraction. I mean, some parts of it might not even feel like a recession, but even in the case of a mild recession, we find it tough for the stock market to remain at these levels because even minor earnings revisions are going to put some weight down on the index.
And so, we're just sort of finishing up one earnings season, but it feels like they are sort of one runs into the next at this point. So do you think then that when the next earnings season starts in earnest, that'll really be sort of a rocky time as we start to see the effect of a slowdown really hit companies' numbers?
Yeah, we do. I mean, we think that the bar has been set quite high for the next earnings sessions. We're talking about double-digit growth in earnings expectations. We think that bar is going to be very tough for the stock market to meet. But even before then, we think we'll continue to see deterioration in the labor market data. There's an interesting sort of analogy here. You could say that with the Fed, the buy the rumor was the dovish pivot of 2023, they sell the news might actually be when they actually cut rates. We think there's a good chance that around the time that the Fed actually does start cutting rates, you could see the market materially drift lower.
So where in the equity market, Ahmed, do I want to be positioned then?
Yeah, as you can imagine, we're sort of tactically positioned rather defensively here. So we like defensive sectors. We like healthcare. We like utilities. We like consumer staples. We especially like the utility sector. I know that's been a very good performing sector. Like I said, we did these rotations back in July. The reason why I like utility so much is because I think you're getting the best of both worlds. Now, hear me out. I think you're getting the defensive side that's going to do well when the Fed is cutting rates. But you're also going to have a good proxy for growth and in the surge of electricity and data storage out there. For the first time in over 10 years, the U.S. electricity consumption is going to be growing by over 10%. So utilities, in a good way, are both a defensive play, but also a proxy to growth.
As you mentioned, that group has already done very well this year. It's actually the best performer in the S&P 500 at this point. So why don't you think it's sort of priced in the dynamics that you're talking about?
Yeah, well, precisely because we don't think U.S. equity markets are priced in recessionary risk. I mean, some parts of it are, right? Like utilities doing so well. But remember, the utilities outperformance really only began a few months ago. So we still think this has quite a bit to run. We'll probably maintain these overweights until the U.S. starts coming out of that recession. And then the more cyclical plays will start working again. We're talking about small caps, financials, those types of names.
Ahmed, always great to have you on the show. Thank you for joining us.
Great. Thank you.